Hello everyone and welcome back to this series 2 on audit with CA Meera Joyshar. Last session we checked on how BRS is used as a manipulating tool, and today I will throw light on how stock is used as a manipulating tool. Surprising? Stock is something which is so evident, right? But yes, it is used as a manipulating tool in most of the companies. Why is stock manipulated? Two major reasons. One, for profitability, and two, to show good or bad asset position. Profitability dressing is very obvious for reasons like investment attraction or for tax planning. Obviously, both of them do not go hand in hand, but based on the need of the company, it is played with. If I want to show a good profitability to attract my investors, I shoot up my sales, and besides that, I shoot up my stock. And to show less taxes, I actually show a less stock and thus reduce my profitability. Going to the asset side, this stock is shooted basically to enjoy good healthy credit lineup and to show a good asset position or a weak asset position depending on the requirement. Most of the times this stock inflation or deflation is maybe a byproduct of the profit dressing, but yes, it is done widely. And let us understand today how we can tackle with it and understand what kind of dressing has happened. Let us understand a situation of a trader who is trading in calculators. He has a stock of say 50 calculators at the beginning of the year. During the year, he purchases say 100 more and sells 110. So a simple arithmetic, right? 50 plus 100 minus 110, 40 is in stock. So if things are so simple, how can you really window dress on these figures? It is simple arithmetic and you can't play with arithmetic, right? But just let me complicate this very example with figures like the same trader is not trading only in X calculator. He is trading in 50 varieties of calculators and selling it across different geographies in different lot sizes, purchasing it from maybe 100 different vendors. When I need to figure out all this, it becomes difficult. Let me add more complexities to it. Trading still can be managed. What happens in case of manufacturing? Especially, for example, manufacturing of steel drums, wherein you purchase steel in the form of say 50 sheets of steel. It is used in manufacturing in kilograms, and the converted final product is again in the form of numbers, X drums. Now, how do you monitor whether there has been any leakage in between? It is very simple. Follow 4 steps and you are done. Step number 1, quantity flow, and the most important chart. In the example which I just quoted, my number is then converted to weight, then converted to number again, and I am all confused on how much was the input, what were the purchases, how much is the output, and what is sold, what is still in my stock. But imagine you just convert all this into one simple bar. I think in this case, it is easy for me to convert into weight. My 25 sheets of steel that are purchased are converted into kilograms. So per sheet is, for example, 2 kgs. So totally I have an input of 50 kgs. I had some 20 kgs as opening. So 50 plus 20 is 70. I use 60 kgs out of it for manufacturing of these drums. These drums in all are manufactured in say 30. So I have used 60 kgs of steel to manufacture 30 drums. So per drum is say 2 kgs. So that is how, if we convert these numbers into 25 into 2, that is sheet is converted into kgs. Then I input the kgs, remove kgs, and at the end, even the drums I measure in terms of kilograms. In such a case, it becomes very easy for me to track what was my opening, what I've purchased, how much I've used for manufacturing. Out of my total 70 kgs, 10 kgs of raw material remains, and 30 drums means 60 kgs of steel. Out of 30 drums, for example, you have sold 25 drums, so I have 5 drums. 5 drums into 2 kg each means 10 kgs. So if this arithmetic is made this simple, you just apply the rates and things become very easy for you. So very important that at every stage, my quantity flow is tracked in a very same measurement pattern. If I have multiple measurement patterns, the management can always keep on telling you this got converted, and so you are not able to monitor on it. More importantly, when I'm applying values, that is my step number 2. Before I go to step number 2, let me get back to the quantity again. When I'm doing a manufacturing, this 10 plus 60, 70, 30, all this is not simple, because in manufacturing, your manufactured product might either gain weight or it might lose weight. Let me give example of a yarn, a cotton converted into yarn and then colored, right? So if I buy 10 kgs of cotton, it might not be converted into 10 kgs of yarn. I might have some dust into it, seeds are there, all that goes out, and what remains? Probably out of 10, only 8 remains. So 8 kg of yarn. This is raw yarn. If I get this yarn dyed, there will be weight added. The color gets added, right? So this 8 kg gets converted to probably 8.5 kgs. So if you want to understand, what you need to do is study the industry. If you are doing a garment for yarn manufacturing, study how much quantity of raw material of cotton gets converted into the yarn. What is the normal wastage? How much of that yarn is added up in terms of the color that it gets dyed into? And then if you measure with considering this normal loss, you will understand what was the opening, what is the input, output, and closing. But if you don't understand the industry, the management can simply tell you, yes, here there was a weight loss, here there was a weight gain, and you are really lost in all those explanations. But one, if industry standards are known to you, and two, if you know the history of that company, every year the normal loss will definitely remain the same. So in any one particular year, you find that the pilferage in between is higher, means they are trying to reduce the stock value. Or if you find the normal loss is less, till last year it was 20%, today it is only 5%. So they have managed the 15% of stock. So that's how you need to really convert every possible complexity of this quantity flow into simple arithmetic, and you are definitely through exact calculations. Step number 2, physical verification. This is again the most important step, because having done all these plus and minuses, if you find there are 500 kgs of X units available with them, and if you don't count it physically, the management will just show what is there on paper. Probably in the factory there might be 700 units or there might be just 200 units. But what is available on paper just goes to the balance sheet, and they are definitely successful in playing with whatever stock figure they want to show. So long as you don't do the physical verification, you are not sure of the arithmetic that you have done. So that is the cross-checking that happens to the step number 1. And in this physical verification, as per my standards of auditing, it is both my responsibility and my right to participate physically into this counting of the stock. The third, any stock which is shown in the balance sheet forms, so composed of two aspects. One is the quantity multiplied by the rate. So my rate, what is applied to the stock, will determine my stock value in the financial statements. So, having determined the quantity through the quantity flow and through the physical verification, now I need to understand what is the right rate to be applied. Now, I have different methodologies whereby I can determine what rate to apply. You've heard about terms like FIFO, LIFO, average costing, right? Again, which kind of method to be applied to which kind of product is a matter of common sense. If I tell I want to apply LIFO to maybe fruits, it is not possible because the fruits that are purchased first will be sold first. Otherwise, they'll get spoiled. And second, if I go for FIFO, but let me explain what is FIFO. FIFO means whatever I've purchased first is sold first. And what remains in my stock are the last products that are purchased. In my example, if I told you there was those 10 kgs of raw material that is lying with me, if I apply FIFO to the last lot of 10 kg that was purchased, is the stock that is there with me at the year end, and I apply the rate which I can see in the invoices in my last purchases. If I'm applying a LIFO, it is just the opposite. My stock that comes in last is sold first, and this is generally not that popularly used. So what we generally use is a FIFO or an average cost. Average cost is something like where I gave an example of calculator. In case of calculator, it is not necessary what is come first will be sold first, right? And it doesn't really matter how it is sold. In that case, I can go ahead and take a decision to value my stock on an average cost. My opening value, my purchases, and whatever divided by the number of units, I come at an average price, and based on that, I can value my stock. Again, how these companies play with the valuation is, in 1 year probably they'll adopt a FIFO, then a LIFO, then an average cost. Whatever is favorable to them, they go ahead with this. So this is something you need to take care. If you find frequent changes, please alert them this is not acceptable. And you need to understand the type of product to apply, which form of stock valuation to adopt, and also study the industry standard. For that category of companies, what is that the industry adopts? And that will help you determine whether the valuation is correct. Fourth and the last point, I need to factor in for all slow moving and non-moving goods. For something like a calculator, and if the calculator is a standard one, which really doesn't matter, it is being used for last 10 years and maybe it is going to be used for next 10 years, maybe this slow moving and non-moving might not make that much of an impact like those, for example, of perishable articles, fruits. If there is this slow moving, non-moving, some particular type of fruit was not sold, it is discarded. What is the meaning of just accumulating it and keeping it, saying it is my stock? You can't do it. I need to discard it and take the value of that discarded product off the value of total stock standing in my balance sheet. So the slow moving, non-moving valuation, either complete discardation, or if you feel that the product might be sold, maybe not today, some days later, only that, for example, in case of cloth, some particular pattern or fashion of a particular cloth is there today, tomorrow the value will go down. So although my cloth will not get spoiled, but definitely the value diminishes. So for that, I need to make adequate provisions for that particular diminishing value. So these are basically the 4 points which you need to take care, and the management will not be able to do any kind of foolish manipulation in front of you. Right? Today's video has given light on the entire stock manipulation, stock taking. I am coming up with similar videos. The immediate next one being an interplay between my purchases, sales, and the debtors and creditors. Stay tuned, spread the word, with all your friends and colleagues. Bye and take care.